Welcome to the comparison of CALHFA, California Housing Finance Agency, versus GSFA, Golden State Finance Authority. And this is updated as of August 5th, 2023. Links to all of the sites that I mentioned today will be in the comments section. These are the two most popular down payment assistance programs in California today. Of course, there are other assistance programs, mainly offered by the various cities throughout the state of California. However, those city programs tend to have restrictions such as income limits or debt-to-income ratios, or even just funding availability. It's been my experience they're not as helpful as CALHFA or GSFA. There are a couple other products I'd like to mention, the Chenoa Fund and the Land Home Within Reach down payment assistance products. Those products have special nuances that can make them a viable option for you. However, in most cases, that's not the case. So I'm not going to feature them in the video today. They'll be featured another time in a different video. Also, those products tend to be more expensive than CALHFA or GSFA. Let's get out our boxing gloves and duke it out between CALHFA versus GSFA and come to some conclusion as what's going to be best for you and your family. That's what we're going to delve in today. And we're going to start off by going over the CALHFA product and talk about how CALHFA works. CALHFA helps first-time homebuyers with down payment and closing cost assistance. You do need to be a first-time buyer, which means you haven't owned and lived in your primary principal residence or resided in one owned by your spouse during the previous 3 years. This program is going to require an education certificate. The certificates are good for 1 year. There, you can get it online and it costs about $99. And I'm going to include a link to it. CALHFA programs are for owner-occupants only. You must owner-occupy the property within 60 days of closing. Non-occupant co-borrowers are not allowed, and they do not allow non-occupant co-signers as well. Eligible property types include single-family residences. You can have an ADU with some parameters around it, but that would be allowed. Condos are allowed. Even a manufactured is allowed. But note, it needs to be a one-unit primary principal residence. They do not do this program on 2 to 4 unit properties. There are two main programs with CALHFA. There's one that is FHA based and one that is conventional based, and we're going to cover that today. Also, CALHFA is known recently for something called the California Dream for All Shared Appreciation Program. That one is currently doesn't have funding available. We will feature that in another video. So I'm going to break down the requirements by version, whether it's the FHA-based product or the conventional-based product for CALHFA. They have income limits that are the same for both, and I've got the link in the comments section. The conventional CALHFA requires a minimum 3% down payment and also requires a minimum 680 credit score. However, if your income is considered to be at 80% or less of the area median income, then you only need a credit score of 660. I've included a link to find that 80% area median income limit. It's also known as the Home Ready income limit. I have clicked on that 80% area median income link because I want you to see how it works so you don't get tripped up there. So once you click on that link, you'll come to a screen that looks like I'm showing you here. You'll see the little disclaimer. You're going to click OK on that. And then you're going to go down to the area in California that you're interested in. So I'm going to come over here. I'm in the Sacramento area, so I'm going to click on that and get myself into that area. Not perfect. I might have to scroll out here a little bit so you can see I'm scrolling out. So here I'm in Sacramento. I'm going to click on an area here. And so you'll see this little box pop up that says area median income $113,900. And then if you look at it, you got 120%, 100%, 80% area median income, LI, 91,120, also known as the home ready income limit. That's the limit for the area that you're looking for. And so if you qualify or fit into that, not only are you allowed to have a little bit lower credit score of 660, but in addition, they have a little bit of a break on the interest rate for you. Okay, CALHFA conventional product has maximum debt to income ratios, and it's 50% if your credit score is 700 or greater. If your credit score is less than 700 or the property happens to be a manufactured home, then you're going to be limited to a debt to income ratio of 45%. Now let's talk about the FHA version of CALHFA. And FHA requires a 3.5% minimum down payment and a minimum credit score of 640. The debt to income ratio limit is 50% if the credit score is 700 and greater. The debt to income ratio is 45% if the credit score is less than 700. If the loan needs to be manually underwritten on FHA, then the maximum income debt to income ratio will be 43%. There are 3 different assistance levels with the CALHFA products, both for the FHA version and the conventional version. The first one is getting a My Home Assistance second, and that one will offer the lowest first mortgage interest rate. The second level assistance will be a My Home Assistance with a 2% second ZIP product. That will actually go in third position. And that one is going to be in the middle as far as the first mortgage interest rate goes. And then the last level assistance will be My Home Assistance second coupled with a ZIP second at 3% of the price for assistance. And this first mortgage rate will be at the highest rate of all 3. The My Home Assistance is going to be a simple 1% second loan on the property. And if it's FHA based, it'll be 3.5% of the purchase price as down payment assistance. If it's conventional based, it will be 3% of the purchase price as down payment assistance. The payments on this product are deferred for the life of the loan. You don't have to make any payments. It becomes due and payable when you sell the property or transfer it, or if you refinance the property, or at the end of the term of the loan, 30 years. It's a 30-year first loan. The additional ZIP assistance loans, those are third loans on the property at 0%, so you don't pay any interest on that whatsoever. And they're deferred just like that My Home Assistance product. So they become due and payable at the end of 30 years, or if you sell or transfer the property, or if you refinance. I've pretty much already explained this, but I'll go over it again. On the conventional product, here's how the assistance level works. The My Home Assistance is 3% of the purchase price, and the ZIP second is going to be 2% of the loan amount for the 2% ZIP product. And then the third one is the My Home Assistance, which is 3% of the purchase price. And then you get a 3% second based on the loan amount on the third option. For the FHA, the My Home Assistance is going to be 3.5% of the purchase price. If you got the My Home Assistance plus the second ZIP, it's going to be 3.5% for the My Home Assistance for the down payment assistance. And then that 2% ZIP second will be based on the loan amount. The third level will be the My Home Assistance at 3.5% down payment assistance of the sales price, 3.5% of the sales price, plus 3% of the loan amount as a ZIP third, a 0% deferred interest second. Okay, so you can see here on the slide, I've got a link to the CalHFA website for their rates. We're going to go here in just a minute so I can show you how to read it. Okay, so I clicked on that link for the CalHFA rates. It'll take you to a page that looks like this. And here we are. It's Sunday evening, August 6th, I guess it is. And I'm laughing because this is what we get on the weekend. They put NA for all of their interest rates, but I'm still going to walk you through it so you have an idea. You'll see that first thing here. I've got my hand on it. It says CalHFA Conventional, no CalHFA DPA, and you would see a rate there for both their standard and their low income rate. I never use this product because it offers no assistance, and the rates tend to be higher than what I could get for you on a regular product. So the next one down says CalHFA Conventional with CalHFA DPA. And so normally there we'll have the interest rate, and then you remember I mentioned the low income rate. That tends to be 1/8 to 1/4% lower than the standard daily rate. And so that would give you the rate there for that product. And then down below, so that you would couple with the My Home Assistance. And then the next one down below, it says Cal Plus Conventional with 2% zero interest program. So that one you're going to be using the My Home Assistance, just like we discussed. And then you're going to get the 2% second zip loan based on 2% of the loan amount in addition to the My Home Assistance. And you'll have the interest rate. It's always higher. And given the very volatile market that we're in at this time, as far as interest rates go here in August of 2023, funds are not always available for this product. So I'll just share that. Sometimes, even on a normal weekday, it'll say NA, or it will have a nice jump in the interest rate. Like a couple of years ago, they were priced very well and the jump wasn't that big. And so I would, get you that additional assistance. Given today's market, a lot of times we might look at it and say, there's other ways to come up with additional funds, maybe by getting a gift from a family member, getting seller assistance if possible, or maybe tapping into your 401k. Always going to look out for what is going to be in your best interest. And I'm also always going to show you your options. What do your options look like? And then you can decide what's best for you. Down below there is the third option, the Cal Plus Conventional with 3%. Same thing as that second. Generally, the interest rate tends to be a bit higher if it's available. And there we go. We look at it and see, how much of a benefit is it worth, versus the pain of paying extra to get that additional assistance. And then scrolling down, you'll see it says CalHFA Government First Mortgage Loan Programs. So the first one says CalHFA FHA, and that one offers the down payment assistance with the My Home. And that is usually the lowest of all the rates, to be honest with you, even though it's not showing today. And then next up is the Cal Plus FHA with the 2% additional assistance based on 2% of the loan amount for additional closing cost assistance. Generally a little bit higher interest rate if it's available. And then just below that is the Cal Plus FHA with 3% zero interest program. And that one there again tends to be the highest rate of all three, but you're getting a lot of assistance. So I'm always happy to show you the options and compare them for you. Below that, you'll see there's CalHFA VA. Now, VA loans, by their nature, are 100% financing for an eligible vet. So that product really would work if you're going to use it for down payment assistance. And not to bore you, but let me put it to you this way. Lenders don't make money doing this. They lose money doing it. And so I do not offer that product. I had a customer try and use it once. I referred her to somebody that I discovered they thought they could do it. They did do the program, and then after doing it, they learned from their company that they lost money doing it, and so they've shut it down. I don't know any lender right now in their right mind that are doing that product. If you find it, yay. But most cases, we take care of it in other ways if we're doing a VA loan for a veteran. Then below that is a USDA. Same thing as the VA. USDA offers 100% financing. There are other ways to get closing cost assistance than using CALHFA. And unfortunately, the lenders lose money when they do this. So the majority of them do not do it. If you need to go that way and you find someone who does, more power to you. I just don't, and I don't know anybody that does. And after hurting my last lender friend, not intentionally, I thought I was giving him a deal. It turned out not to be that way. Fortunately, my loan officer buddy turned out fine, but his company took a hit in the shorts. So that's no fun. Scrolling back up here, I'm going to look at this conventional again. You'll see something that says high balance loan limit fee. And what that is CalHFA allows us to do what's called a high balance loan. So conforming loan limit is $726,200 currently here in 2023. And we have what's called a high balance agency loan limit that lets us go up to $763,600 in my area of Sacramento. And so if you're looking for that high balance, they do have a little bit of an additional fee, and that would be put on there during the normal weekday. It can be as much as an extra point cost to get it. And so when we're analyzing loans, we look at the pros and cons of what's going to work best for you and your family and let you make your decision. All right, enough of CalHFA. It's time to bring our next contender, GSFA, Golden State Finance Authority. And there's two main product types with GSFA. There's the platinum set of products, and then there's the golden opportunities. There used to be something called the Open Doors program that was quite popular. However, it's been put on hold as of March of 2023 until further notice. We'll provide an update if that does become available again. Let's go over the highlights of the Platinum program. First off, it offers financial assistance up to 5.5% of the first mortgage loan amount. That assistance can be used towards down payment and/or closing costs. The home buyer does not have to be a first-time home buyer to take advantage of this product. That's in comparison to the CalHFA. Perfect credit is not required on this program. They'll allow credit scores all the way down to 640 on the GSFA Platinum product. The debt to income ratio limit is going to be 45%. In some cases, they'll allow you to go up to 50%, but your credit score needs to be 680 and better. And if it's a manufactured home, then we're still going to be limited to 45%. Eligible property types include 1 to 4 units. That's comparison to CalHFA that will only work on 1 unit properties. This product will work on 1 to 4 units, single families, of course, condos, and even manufactured homes. It does have income limits that are fairly flexible. Note that FHA and VA do not have income limits. USDA will go by normal USDA guidelines for their income limits. And the conventional income limit, I provided a link below so we can take a look at that. Okay, so I've clicked on the link for the income limits with GSFA, and it takes you to a screen that looks like this. And if you'll scroll down, you'll see FHA, VA, no limits for FHA and VA loans. The USDA will go by their guide limits. And over there on the right, it says Freddie Mac conventional loans. So the conventional product is going to go by Freddie Mac guidelines. You'll see here it says pick a county. So you're going to click on that little arrow and scroll down to the county that you happen to be looking in. Let's say that we're looking in Placer County. So I click on that. It kind of populated a screen there. So you'll see the conventional loan limit for Placer County is $184,320, and then 80% of the area median income is $81,920. And it's making a note here, borrowers with income at or below 80% have more attractive pricing and or reduced mortgage insurance. So we can get into that if that applies to your particular situation. Most folks it doesn't, so I'm not going to delve into that today. But that's how that works. As you can see here, GSFA offers various different first loan mortgage types: FHA, VA, USDA, and conventional financing. The GSFA Platinum products has 3 different types. There's the Platinum Standard, there's the Platinum Select, and there's the Platinum Assist to Own. The Platinum Standard offers 5% of the first mortgage loan amount as assistance in the form of a 15-year second. The rate is the same as the first mortgage rate, and it does have monthly payments. The Platinum Select is similar to the Platinum Standard, but it's select because there's certain qualifying occupations that will get an additional break. So the base of it is you're going to get financial assistance of up to 5% of the first mortgage loan amount in the form of a 15-year second mortgage. The rate is the same as it is on the first, and it does have monthly payments. Certain qualifying occupations, we'll call them select occupations, can receive potentially up to an additional 1.5% of the mortgage loan amount in the form of a gift that does not have to be repaid. But this is subject to market conditions, and given the market volatility that we have recently, oftentimes they don't have funding for this additional assistance. I put the qualifying select occupations in the slide. I can't remember them all, but basically, those that are in law enforcement will qualify, those that are involved with firefighting qualify, those that are in healthcare qualify, and those that are in the education system, they qualify. Lastly, we've got the Platinum Assist to Own, and this is for qualifying member counties and employees of those counties. So you have to be an employee of a county that is qualified. And so they've got a link that I'll share with you that shows the counties that qualify for this additional Platinum Assist to Own product. The primary assistance for the Assist to Own product is 3.5% of the first mortgage loan amount, and it's deferred second. The rate on the second is 0%, and it must be paid when you sell, transfer title, or refinance. In addition, the Assist to Own product offers an additional 2% of the loan amount as additional assistance in the form of a gift that does not have to be repaid. However, note, it is also subject to market conditions. So sometimes there's simply not funding available for it, but when there is, they're getting an additional 2% along with that 3.5%, making the total assistance available 5.5% of that first mortgage loan amount to assist employees of the member county that qualify to utilize the program. Okay, so I clicked on the link for the GSFA Platinum products to see the rates, just so you can see what that looks like. It is Sunday night, so it's currently offline, but this is where the rates were last. The first Ginnie Mae rates, FHA, USDA, and VA, that shows the rates that are available. And you can see here, I'm going to go to the highest rate because that gives us most amount of assistance, and that's what most people want to do. So on the standard product, 7.25 on the first. The second is also at 7.25. It's up to 5% of the first mortgage loan amount. It's amortized over a 15-year, and it has monthly payments. The Assist to Own in the second column there, the rate on the first is 7.25. We've got a DPA second, which is that second rate is 0%, and it's up to 3.5% of the first mortgage loan amount. And they're going to give us a 1.5% of the first mortgage loan amount as a gift. So the total down payment assistance is 5%. You notice that I mentioned earlier, it can give you up to 2%, but currently they only have available 1.5% is what they're giving us. This does change week to week, day to day. So, welcome to being a loan officer. You get to look at this stuff and see where they're at on the day that you're trying to put something together. The third column is select for those select occupations: police officers, firefighters, healthcare, education people. So 7.25% on the first, 7.25% on the second, 3.5% of the purchase price, payments due on it, amortized over 15 years. And in this case, they're giving 1.5% gift is available. Total DPA is 5%. Scrolling down, you'll see the next middle column there is Freddie Mac, 80% of the area median income. So we were looking at it before, and I mentioned that 80% area median income. So those that fit that criteria fall into these rate categories. So the standard, you're at 7 3/8. The assist to own is at 7 3/8, and the select occupations are at 7 3/8. Well, yeah, it's a little bit higher than the FHA, which is standard for conventional. I see that all the time. And then the bottom row there is the conventional loans. Freddie Mac is a conventional based product. And if your income is above 80% of the area median, which most people are, then this is where you're going to fit. And so there you can see 7 3/8 on the first and on the second. I'm looking at the standard column. Total down payment assistance is 4.5% that you can get. So you compare that to the 80% area median and you get just a little more assistance. They're giving you 5%. Rolling over to the assist to own column, you'll see 7 3/8, 3.5%, and then they're only going to give you 1% gift in this case, whereas 80% of the area median, you're at 1.5%. So little bonus there. The last column, select, 7 3/8, 3.5 on your second, and again 1% gift. So that gives you an idea of what that looks like. Hope it's helpful. It is when you click on that link, you're going to get this screen. The yellow highlighted counties are the counties that qualify for that program. Next up is the Golden Opportunities Program. Very similar to the Platinum products with a few little minor nuances. Let's go over the program highlights. This program offers up to 5% of the first mortgage loan amount as assistance. The assistance can be used towards down payment and/or closing costs. The home buyer does not have to be a first-time home buyer. Perfect credit not required. It will allow you to go all the way down to a 620 credit score. The debt to income ratio can go all the way up to 55% in some circumstances. Eligible property types. Note, this one only allows a 1 unit, no 2 to 4 units, 1 unit only, single family, condo, townhouse, and even manufactured. There are various first mortgage loan types, but not conventional. So you've got FHA, you've got VA, you've got USDA, but conventional is not available on the Opportunities Program. And of course, there's no income limits for the FHA or VA loans. The USDA is going to go by normal USDA guidelines. The Opportunities Program gives you 3.5% of the mortgage loan amount as assistance, and it's on a 15-year second. The rate on that second is the same rate as on the first, and it does have monthly payments. There's an additional 1.5% of that first mortgage loan amount that can be in the form of a gift. And again, it's subject to market conditions, and it's up to 1.5%. Of course, a gift does not have to be repaid. Next, we'll click on the link to the Golden Opportunities Program so you can take a look at it. Okay, so I've clicked on the link for the rates to the Golden Opportunities Program, so you can take a look at it. Sunday night, it's offline. This is where it left us last week. So you can see the 7.25 is the going rate for it today. First and the second, obviously, same rate. And that's 3.5% of the first mortgage loan amount. And then the gift, right? They allow a gift up to 1.5%, but all they have available right now is 0.5%. Again, this varies all the time. So currently we can get a 0.5% gift. Okay, to sum it up, let's go over the key differences between CALHFA and GSFA. First key difference on CALHFA, you must be a first-time homebuyer. On the GSFA, you don't have to be a first-time homebuyer. Number two, on CALHFA, it's going to be one unit primary residence only. GSFA allows, it's got to be primary residence, but they do allow 1 to 4 units on their platinum products. Number three, CALHFA does not allow non-occupant co-borrowers. On GSFA, it may be allowed on particular products, usually FHA backed. Number four, CALHFA will allow manual underwriting on an FHA product, which allows for a little more flexibility. GSFA does not allow manual underwriting. Number five, on the CALHFA conventional products, you need a minimum credit score of 680 or 660 if you're 80% of the area median income. If it's a GSFA conventional product, your credit score can be as low as 640. Number six, CALHFA FHA-based products have a 640 minimum credit score. The GSFA for FHA and VA will allow the credit score to be as low as 620. Number seven, the CALHFA-based products, FHA and conventional, allow the high balance loan limits, whereas the GSFA is limited only to the conforming loan limits of 726,200 as of 2023. On the CALHFA products, the payments are deferred. On the GSFA products, for the most part, the payments are not deferred. You've got a not deferred portion and then sometimes a portion that can be a bit of a gift. Lastly, the CALHFA rates on both the first and the second tend to be lower than the interest rates on the GSFA products. The GSFA products on both the first and the second tend to be a bit higher. And depending on the level of gift that you may be getting for your particular, let's say, select occupation, can play into the overall picture of whether or not it's beneficial enough to do it or not. In most cases, the CALHFA products, the payments wind up being less. The fact that they're deferred in the long run, most folks are going to choose the CALHFA. Of course, if we're not a first-time home buyer, then GSFA is going to win out. If we're looking at 2 to 4 units, GSFA is going to win out. Next, I'm going to do a little tool that I have to show you how it breaks out on some CALHFA products and then how it breaks out on some of the GSFA products. Okay, so now I'm going to share with you how these numbers break out on the CALHFA products. Today is Monday, August 7th of 2023. I decided to wear the same shirt for you just to have continuity with this little video. Normally, if you're on a computer, I provide this kind of analysis and comparison for all my customers. And I normally explain if you're on a computer, you can click and drag the box I'm talking out of to anywhere you want on the screen. And so in this case, I would have you go down to the summary quote date area. And I've got 3 options that I've done here. I've done the CALHFA with the My Home on a conventional product, and then the CALHFA My Home on the FHA product. And then the third column, I did the CALHFA My Home plus that 2% zip second on the conventional product. And that was all that was available here today. So the zip product, the third option where you get 3% of the loan amount as assistance, was an NA today. And on the FHA, all we had was the My Home getting the additional 2% and 3%. Both of those were not available either. So let's go down and look at this first column. I did these all based on a $500,000 purchase price. I custom tailor these for all of my borrowers based on what they qualify for and what they want to see what the numbers are looking like. So first column there, $500,000, you'll see the loan amount. That's a 3% down payment. The interest rate today on CalHFA is at 7% on a 30-year fixed rate loan. And so there's the total monthly payment with everything included, principal and interest, property taxes, homeowner's insurance, and mortgage insurance. And then the total cash to close, down payment, and all of your closing costs also highlighted in yellow at $21,839. And that does take into account the assistance that you're going to get from CalHFA. So that's the first column. The second column is the My Home with the based on the FHA loan. That rate, as I mentioned, the government loans tend to be lower, so it's 6.75% today. And so you can see the payments a little bit less and the cash to get in relatively the same. And then the third column is where we're getting additional assistance. So we're not only getting the 3% of the sales price as down payment assistance, but 2% of the loan amount as closing cost assistance as well. Higher interest rate, they've jumped it up from 7% all the way up to 8%. So here you can see we're looking at higher monthly payments, and then the cash to close is at $12,405. Just above that third column is a more info tab. I'm going to click on it for us. So here I go. And when I do that, you're going to see that you get 3 more tabs: payment breakdown, closing costs, reinvestment. We're on the payment breakdown right now, so you can look at each one of these and see how the payments break down in each scenario: principal and interest, property taxes, homeowner's insurance, mortgage insurance, full monthly payment. Click on the closing cost tab. You can see down payment, it says loan to value, APR costs, non-APR costs. I'm not going to bore you with explanations on that right now. I'm going to take you down to where it says fee detail. It's highlighted in blue. Let's click on that, which I just did. And so when you do that, you're going to see a detailed estimate of all the closing costs broken out. And then I'm going to highlight here for you the CalHFA second proceeds, minus $15,000. That's 3% of the purchase price, and that $15,000 is going towards down payment and closing costs. And so there you get a breakout of all the costs and fees. Everything's been included, and you can check these out, per each column there. The FHA loan, you'll see that they've got the second proceeds at minus $17,500, which is 3.5% of the purchase price. And then the third column over, the My Home zip, and I was able to highlight the second proceeds. And all the way at the bottom, you'll see the third proceeds, which is 2% of that sales price as an additional assistance. And that's what's getting the total cost to get in a lot lower, only $12,400. Bluntly, interest rates are high right now compared to where we have been and compared to the price points, at least in my area in Sacramento, California. But this is what it looks like. Next, we're going to jump into some GSFA products and look at those, and then you can come back or scroll back on the video and see how they compare. So here I've done some options with the GSFA products. And so I want you to go down to where it says summary quote date, and you'll see the first column is the GSFA Select Platinum. So for those qualifying occupations where they get that little bit of additional assistance of 1.5% gift in this particular case. So here you can see purchase price $500,000 in each scenario. The rate on that today is at 7.25%. And so the total monthly payment highlighted in yellow, $43.54, and total cash to close fairly low, only $14,300, and that takes into account the first and the second and the gift, the assistance that you're getting. So that's the select, and that's with the FHA based product. And then I just did it compared to the standard. So you're not getting the gift and you've got a bigger second, which is going to make your payments a little bit more. So the rate's the same, but the monthly payment is going to be higher, $44.22. And then the cash to close, roughly the same, about $14,050, give or take. So there's that. And then the third column is I did the Platinum Select based on a conventional product, so we can take a look at that. And the first interest rate is at 7 3/8 on that one. And then you've got a little bit of a gift. So going down here, total monthly payment is about $4,500. It's because the mortgage insurance is more expensive. And then the cash to close, roughly the same, $14,082. Fourth column is the GSFA Golden Opportunities Program. And on that one, they're only offering about a 0.5% gift today on that one. The rate's 7 1/4 on the first. So you can see the total monthly payment. And then, of course, the cash to close is a bit more. It's about $19,130. So just as before, you can click on the More Info tab, and you'll get a payment breakdown, and then you'll get the closing costs, where you can click on that, scroll down to Fee Detail, and get a detailed estimate of all the costs that are estimated in these, and then, of course, the gift that's being forgiven. And so you can look at that on each one of those scenarios. Last but not least, I'm going to take a screenshot of each one of these so that you can look at the GSFA side by side to the CALHFA. And should you have an interest in either one of these products, we can do a side-by-side comparison for your unique situation on that particular day, right? Because things change month by month, especially in the markets that we've been involved in, with the rates being a bit higher than normal and a little bit volatility. So we can compare and decide what's going to be best for you and your family. But for grins, we're going to put these two side by side, the GSFA and the CALHFA, so you can take a look at that on one screen. Okay, so I've done a screenshot of both the CALHFA and the GSFA. The CALHFA products that we went over there on the top of the screen, and the GSFA products are at the bottom. So we can take a look here, and you'll notice that the CALHFA products do tend to have lower overall payments, but the cost to get in appears to be higher, other than the program whereby we're getting that extra 2% assistance all the way there on the third column for the CALHFA. So you get in for less money, like 12 grand, but then your payments are jumping up to $4,600 per month. If we look down at the GSFA products, a little less overall cash to get in for the GSFA products, but the monthly payments do tend to be more, other than that Golden Opportunities product, which has higher money to get in and a bit higher on the payments. So I think the biggest deal is going to be, hey, are you eligible to get a bit of a gift? Because if you do, you fit into one of those select occupations or the assist to own, then currently the GSFA may work out better for you. If you don't have those and you're just a regular first-time buyer, then the CALHFA products may actually turn out to be better. But each person's situation is unique, and that's why we take the time to go over it and figure out what's going to work out best for you. And then I will provide you, if you're working with me, an analysis with tools so you can take a look at it. You'll get a link that you can go over with whoever it is you want to consult with. If you've got parents that are going to review it with you, or your husband, or a friend, or whoever it is, you've got a link that you can open up at any time and watch the video recording that I create for you and take a look at those numbers and really think what's going to be best for you. Wow, you've made it all the way through this. I want to thank you for taking the time to invest in yourself and educate yourself about down payment assistance products. And for that, I want to offer you a little bit of a gift for spending this time here with me and for you. So I'm going to say for the next 6 months, and wink, wink, I may even extend it up to a year. But for now, I'm going to say for the next 6 months, if you, and this is as of August 6th of 2023, if you'll send me an email that says DPA credit to my email address, mark.teran@apmortgage.com, I will offer you $695 off of your closing costs when you close your loan with me. So a little extra benefit bonus for you. Send me an email. Hope this has been super helpful and hope to hear from you. Thanks.